What if I told you that history is on the verge of repeating itself? That the next economic collapse could be just around the corner? And this time, it's Deutsche Bank that is in the crosshairs. If you thought the 2008 financial crisis was bad, get ready for Lehman Brothers 2.0. Deutsche Bank, one of the largest banks in the world, is teetering on the brink of disaster. Its share price has been plummeting for years, and the bank is struggling to keep up with new regulations and legal challenges. Many experts are warning that Deutsche Bank could be the next Lehman Brothers, the bank whose collapse triggered the 2008 financial crisis. But what does this mean for you and your investments? Are you prepared for the aftershocks of another economic collapse? Have you diversified your portfolio and taken steps to protect yourself from a potential financial meltdown? In this video, we'll take a deep dive into the current state of the Deutsche Bank and explore the potential ramifications of its collapse. We'll examine the lessons we can learn from the 2008 financial crisis. Don't be caught off guard when the next financial crisis hits. Join me as we explore the potential Lehman Brothers 2.0 and what you can do to prepare for the aftershocks. Let's begin with a shocking fact. The year 2022 has marked a major milestone in global stock markets, with a jaw-dropping 9% fall at the end of September, something that hasn't happened in half a century. In 2023, the world watches nervously as the stock market charts continue to plunge, wondering when or if the market will ever stabilise. But that's not all. The spectre of large banking institution looms large, with mounting concerns about their stability. The banking industry has long been seen as a pillar of financial stability, but cracks are beginning to show, and investors are growing increasingly uneasy. In particular, one institution is causing a stir: Deutsche Bank. With mounting debts and risky investments, many experts believe that the bank is on the brink of collapse. Rumours are swirling about a potential Lehman Brothers moment, and the consequences could be catastrophic. Deutsche Bank is a German multinational investment bank and financial services company. With operations in over 50 countries and a significant presence in key financial centres such as London, New York and Frankfurt, it is one of the largest banks in Europe and the world. For over a century, Deutsche Bank has been providing a wide range of financial services to corporations, governments and individuals. From investment banking and commercial banking to asset management and wealth management, Deutsche Bank has been a crucial player in the global financial system. But with great size and reach comes great responsibility. Deutsche Bank's activities and performance have an impact not only on its own clients, but also on financial markets and the broader economy. Its financial health and stability are closely monitored by regulators and market participants, giving it systematic importance and the potential risk it could pose to the financial system if we were to face significant difficulties. In recent years, Deutsche Bank has faced a number of challenges. It has been hit by various scandals, including allegations of money laundering and market manipulation. It has also struggled to maintain profitability in a low interest rate environment and faced regulatory scrutiny for its risk management practices. On Friday, March 24, the bank's stock went down for the third day in a row, closing with a loss of nearly 8.5% after trading at a loss of nearly 15%. In just the last month, the price of the bank's shares has dropped by 24%, alarming investors around the world. Shares of the bank particularly recouped their losses on Monday. An analysis convinced buyers that the German lender was in good financial shape. According to a Bloomberg article, shares of the largest bank in Germany ended trading in Frankfurt up 6.2%, making it the top performing stock in Europe's STOXX 600 Banks Index. Deutsche Bank has been through a financial crisis before, so this is nothing new. The bank attempted to compete with the investment banking giants of Wall Street just before the 2008 recession, which led to a number of difficulties. Hence, the bank revised its strategy and operations, resulting in layoffs and increased emphasis on the European market. The bank's reorganisation paid well, as in 2022, it posted its greatest yearly profit since 2007. Shares of Deutsche Bank have suffered greatly over the previous month, with selling pressure remaining high right up until last Friday. As a result, the development of credit default swaps to hedge against the bank's default has occurred. Following the recent failure of two major US banks, Silicon Valley Bank and Credit Suisse, investors have become increasingly apprehensive. Deutsche Bank attempted to calm investor nerves by addressing their concerns about the bank's debt. The bank extended a redemption offer for a different subordinate bond on March 24, with a maturity date of 2028. To appease the worried investors, it also offered to repurchase the bonds at 100% of their principal value plus interest. Deutsche Bank is one of 30 banks recognised as GSIB's global synthetically imported banks. Such institutions are required to maintain larger capital reserves in accordance with international regulations because their failure could result in widespread financial losses. That's why traders and analysts all over the world are keeping tabs on what's happening at Deutsche Bank right now. The sell-offs of bank shares and capital contingent bonds have persisted despite efforts by financial regulators to allay concerns following the banking crisis, suggesting investor fears of an approaching recession. Pressure from the market on Deutsche Bank is a prime example of these worries. Deutsche Bank DB shares have dropped by more than a fifth this month, despite the bank's increasing financial performance in previous years. Current monetary and financial stability policies may be unable to turn the situation due to the widespread extent of the banking crisis and fears of credit losses. Deutsche Bank has had some recent triumphs, but investors still seem to be worried about the future of the banking industry as a whole. Yet, following the worldwide economic collapse of 2008, investors have displayed a lack of faith in banks, despite regulatory statistics suggesting the safety of the banking system in the United States and Europe. European banks are currently trading at a P/B ratio of 0.6, while American banks are trading at a P/B ratio of 1.4, both of which are roughly half of their respective pre-2008 norms. The ensuing upheaval in the banking sector underscores concerns that financial institutions could be unable to weather the current and predicted stormy economic climate, particularly in light of the projected recession that will result in losses in financial institutions, loans, and credit portfolios. Financial authorities have identified various potential loss-generating exposures, such as commercial real estate, construction loans, and leveraged loans packaged into collateral loan obligations, making credit risk the second shoe to drop after interest rate risks. Outside of the banking industry, these financial products have found their way into pension funds, insurance firms, and investment funds, leaving some of these institutions open to investor redemption runs. Central banks and financial authorities have tried to comfort market participants with new regulations, but such measures may have had the opposite impact. The Federal Reserve and the European Central Bank have both continued to tighten monetary policy in recent months, but their rhetoric has shifted in ways that suggest they are willing to accept a recession in order to get inflation under control. Since banks and other non-banking financial entities are seen as a weak link, market participants are focusing on them. Despite assurances from central banks that they will keep an eye on signs of financial market instability and be ready to inject liquidity if needed, it's unclear whether or not this will be enough to calm the market down. Lack of trust from investors rather than concerns with banks' liquidity or solvency is to blame for the current crisis. Hence, central banks should prioritise preventing a full-blown global financial catastrophe by being more flexible in their interest rate decisions to calm down equities markets, especially for banks. In addition, they should express their determination to stabilise inflation. This is difficult to do in the current polarised political climate, but the risks of a recession and banking crisis pose considerably larger stakes for everyone. Further, central banks should work together and coordinate their moves so as not to add to market volatility. Restoring market stability is dependent on their capacity to restore investor trust, which can be greatly aided by a coordinated effort. Additionally, regulators and authorities should take preventative measures to deal with financial system weaknesses and reduce associated risks. Stress tests, higher capital requirements, and better risk management are all potential steps in this direction. Non-bank financial institutions, such as investment funds, pose their own unique set of risks that must be addressed and appropriate measures taken to ensure their stability. The current crisis has shown how critical it is to keep the financial system strong and secure. It is imperative that central banks and regulators collaborate to resolve the issue plaguing the banking sector and stop the crisis from spreading. This calls for quick and firm action, as well as the flexibility to adjust to shifting conditions. However, there are steps that Deutsche Bank can take to avoid such a crisis. First and foremost, Deutsche Bank needs to address its structural issues. The bank has been struggling for years with bloated costs, ineffective operations, and poor risk management. These issues need to be addressed if the bank is to avoid a crisis. Deutsche Bank has already taken some steps in this direction, including restricting its businesses and shedding non-core assets. However, more needs to be done to streamline its operation and cut costs. Another key factor is the need to address Deutsche Bank's balance sheet issues. The bank has a large amount of outstanding debt, which has made it vulnerable to stocks in the financial markets. Deutsche Bank needs to reduce its leverage and strengthen its capital position. This can be achieved by selling off assets, reducing costs, and raising capital through equity or debt offerings. In addition, Deutsche Bank needs to improve its risk management practices. The bank has been criticised for its lax risk controls, and this has contributed to its current predicament. Deutsche Bank needs to implement stricter risk management practices and better monitor its exposure to various types of risks. This will require a cultural shift within the bank, as well as investment in new technology and processes. Another important step for Deutsche Bank is to enhance its transparency and communication with stakeholders. The bank needs to be more open and clear about its financial position and the steps it is taking to address its challenges. This will help to restore confidence in the bank and reduce the risk of a run on its deposits or a panic in the markets. Finally, Deutsche Bank needs to work closely with regulators and other stakeholders to address its challenges. The bank is a systematically important financial institution, and its failure could have significant repercussions for the global financial system. Deutsche Bank needs to work with regulators to ensure that it is complying with all relevant rules and regulations, and to address any concerns that regulators may have about its operations. And that concludes today's video. Thanks for watching. So what are your thoughts about the imminent collapse of the Deutsche Bank, and what can be done to avert this disaster? Share with us in the comments below. Make sure you subscribe to this channel with the bell notification if you enjoy watching our content. We upload some informative and interesting stuff here which you would most certainly enjoy. Hit the like button on this video and leave a comment below. See you guys in the next one.